Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
We're going to end on a discussion of emerging markets because clearly, as we looked at the table for $1 trillion stocks, emerging markets have had an extraordinary amount of attention over the past week, some blowout numbers by indices, and a suggestion that this is perhaps the end of American exceptionalism as the tech story has moved way beyond the US borders into Asia. I think an interesting chart of the week from Oxford Economics is showing the performance of MSCI emerging markets versus MSCI US if we strip out those $3 trillion stocks that were mentioned before, TSMC, Samsung, and SK Hynix. If we strip those stocks out, we have the red line in the chart at the left. The red line shows that emerging markets really have underperformed relative to the US MSCI. If we add those three stocks back in, they have outperformed. Now, of course, the US MSCI will also have had tech stocks of its own in there. So we should probably do an apples with apples comparison. But we can see that when we include all tech stocks, there has been a significant, I'd say, late incoming arrival of the Asian tech stocks in order to compare their performance to the US. Another interesting chart by the same firm, Oxford Economics, looks at the perceived macro risk in emerging markets and how this has changed in the aftermath of the Iran war breaking out. And there are three risks that they look at: GDP, inflation, and policy rate. And these move exactly in reverse, as you might expect. You can see that there has been an upward revision significantly in the case of inflation, a little bit more modest in the case of policy rate, upwards in terms of inflation increasing and the expectation for rates there to increase. There has been then, when it comes to GDP, a significant revision downwards. So clearly the Asian markets are more exposed to the Iran war than we might have thought. And this, despite the fact that there has been very strong performance on behalf of the $1 trillion stocks, clearly the emerging market macro situation has been deteriorating, and this will have affected other sectors such as consumers, etc. So this reason this is important for portfolio considerations is most investors will have had a broad-based global exposure, which will have included emerging markets. This will have been a drag until this year. It is significantly performing this year, as we can see with the tech stocks in there. Emerging markets performing well is obviously a good thing in terms of an overall equity market portfolio performing well, but there is a risk that the concentration in these tech stocks is now only spreading to emerging markets. And we will question, we spoke about the equity risk premium earlier. There is traditionally being a much higher risk premium in the case of emerging markets, and whether this risk premium is also eroding. Another point to bear in mind is that the dividends in emerging markets have traditionally been higher. There has been a greater emphasis on dividends in these markets over the years, and there are certain investors in these markets who invest specifically for the dividends. So having a dividend yield in emerging markets that is higher could be another reason for investing there. But overall, for investors, a consoling thing to see that a global exposure has started to pay out, but equally to be concerned about the risk in place there.